Welcome to this professional explainer. Today we are breaking down Chapter 17A of the new Income Tax Act 2025, specifically focusing on the assessment of firms, association of persons, and legal representatives. Whether you're a chartered accountant, a tax student, or a business owner, you are absolutely going to want to understand these new provisions.
But let's start with a practical situation. As a tax professional, you're bound to face scenarios where you need to figure out the exact tax liability when an individual suddenly passes away. Or think about a short-term joint venture that's put together just for a local 3-month festival. What happens to the tax liabilities when that venture dissolves almost as quickly as it started? These aren't just textbook questions. They happen in the real world every single day, and the 2025 Act handles them in very specific ways.
So let's dive right into Chapter 17A, specifically Sections 302 through 331, to see how we handle these special life cycle events. Before we get into the weeds of the specific sections, there's a foundational shift from the old 1961 Act that we really need to talk about. We all remember constantly juggling the dual concepts of previous year and assessment year, right? It was a recipe for endless confusion. Well, under the 2025 Act, that whole system has been completely streamlined into a single, unified concept called the tax year. It aligns perfectly with the financial year, which means no more mental gymnastics trying to map out when income was earned versus when it actually gets assessed.
As you can see from this terminology equivalence table, the shift is pretty brilliant. The new tax year concept acts as your single reference point for both earning and assessing income. So, income earned in the financial year 2026-27 is simply assessed for tax year 2026-27. It's a massive simplification for compliance, and it's going to save us a lot of headaches and interpretational disputes on the e-filing portal.
Moving right along to Part 2, let's break down the actual legal provisions governing legal representatives, firms, and AOPs.
We'll start with Section 302. Under this rule, a legal representative essentially steps directly into the shoes of the deceased. They take on the liability for the tax assessments and computations that would have applied to that individual. The whole goal here is continuity. The tax department needs a reliable point of contact to recover any dues. But there is a crucial limitation you've got to remember. The legal representative's liability is capped. It's generally limited strictly to the extent that the deceased person's estate can actually cover the tax obligation.
Now, Section 318 is where things get really interesting, because the law actually accelerates the timeline for temporary setups. If an association of persons or a body of individuals is formed for a highly specific event and then dissolves shortly after within that exact same year, its total income gets assessed and taxed right then and there within that very same tax year. The assessing officer is not going to sit around waiting for the year to end. They act immediately to collect taxes before the entity just vanishes.
All right, shifting gears to partnerships and firms. There is a magic number you need to burn into your memory right now, 20,000. When you're dealing with the remuneration of firm partners, 20,000 rupees is your critical threshold under this new regime.
Here is how it works. If a firm credits or pays any sum, be it a salary, a commission, a bonus, or interest to a partner, and that amount crosses the 20,000 rupee mark, mandatory tax deduction at source kicks in. You have to deduct TDS at a prescribed rate of 10%. This is a super strict compliance checkpoint for any business distributing profits or remuneration to working partners. You literally cannot afford to miss this.
Let's look at some practical taxation scenarios to really cement how this plays out in the real world.
Imagine a joint venture is formed exclusively to manage a 3-month cultural festival. Step 1, the AOP is born. Step 2, the festival wraps up, and a few weeks later the AOP officially dissolves, all happening within the exact same tax year. Because of Section 318, the assessing officer steps in at Step 3. They assess the income for that specific 3-month active period immediately, closing it out entirely within the current tax year instead of rolling it into the normal, longer assessment cycle. Now, for a firm example. Let's say a firm decides to pay a 50,000 rupee bonus to one of its partners. Right away, you should recognize that this shatters that statutory threshold of 20,000 rupees. So, the firm is legally required to deduct a 10% TDS, which comes out to exactly 5,000 rupees. And this deduction has to happen at the time of credit or payment, whichever happens earlier. Skipping this simple math will land the firm in a lot of hot water.
Speaking of hot water, let's move on to Part 4 and talk about compliance issues and some really common pitfalls under the new Income Tax Rules 2026.
For example, if you need to determine the fair market value of an interest in a firm or an AOP, say because a partner is leaving or the firm is restructuring, Rule 11 of the 2026 rules applies. You can't just guess a number anymore. The rules mandate using a merchant banker or a qualified accountant to apply an internationally accepted valuation methodology. It's a formal process that factors in liabilities, and then the value is allocated strictly based on the members' capital contributions and profit-sharing ratios.
Now, from a filing perspective, this update is honestly a massive relief for all of us. The fragmented tax audit forms from the old 1961 Act, the alphabet soup of forms 3CA, 3CB, and 3CD, they have been completely overhauled. Starting from tax year 2026-27 onwards, under Section 63 of the new Act, they are entirely merged into a single, unified Form 26. This makes disclosures so much cleaner and perfectly aligns with the new system.
But, as with any major transition, there are definitely pitfalls. A really frequent and honestly incredibly costly mistake businesses make is suffering a complete disallowance of partner salary or interest under Section 271. If a firm drops the ball on strict statutory compliance, the assessing officer will just disallow those deductions entirely. Boom, gone. Also, during this transition phase, you have to be super vigilant on the e-filing portal. Do not select the old assessment year when you actually mean the new tax year. And please, whatever you do, don't forget to deduct that 10% TDS the very moment you credit a partner's account.
All right, we've covered a ton of ground today. Let's do a quick recap of Chapter 17A to make sure you've got the essentials locked in.
Here are your core pillars. First, under Section 302, legal representatives step right into the shoes of the deceased to handle tax liabilities capped by the estate's value. Second, under Section 318, short-term AOPs are assessed and taxed immediately upon dissolution. No waiting around. Third, any partner payouts over 20,000 rupees trigger a strict, mandatory 10% TDS. Fourth, sloppy compliance will hit you hard with Section 271 disallowances. And lastly, get comfortable with the unified tax year concept and start getting your systems ready for the new, streamlined Form 26.
So the ultimate question for you to take away is, are your practice templates and workflows updated for these massive changes yet? Thank you so much for watching this explainer. Please like, subscribe, and share to stay ahead of the curve. This video is for educational purposes only and does not constitute professional advice. Tax laws are subject to amendments. Please consult your professional advisor before taking any action. This is an AI-generated educational video. See you in the next one.